if you're somebody who receives restricted stock that's subject to a vesting schedule, then you need to be aware of an 83B election. What an 83B election does is it allows you to pay ordinary income tax on the receipt of that stock, like when it was granted to you,
The fair market value
at the fair market value on the date you receive it. If you don't file the election by default, you have to pay ordinary income tax on the fair market value of that stock when it's fully vested. So it can best be explained by an example, right? So say you go and work for a startup company, and the startup company's strapped for cash, but as an incentive to get you to come work for them, they're going to give you stock options, some restricted stock in the company that, let's say, has a fair market value of $1,000 on day one, but it fully vests after 5 years. So on day one, that stock is worth $1,000 to you. But then let's say after 5 years of employment, it fully vests and there's been significant growth in that company, and that stock is now worth $500,000. So if you filed an 83B election when you received that stock, when you were granted that stock on day one, you can go ahead and pay ordinary income taxes on that $1,000. If you don't file an 83B election, you do nothing when you receive the stock, when it's granted, but when it fully vests after year 5, that's when you pay ordinary income taxes on the $500,000. So it's really a timing issue between when do you want to pay the ordinary income taxes on the receipt of this as compensation. Do you want to pay the ordinary income taxes when the stock is granted to you at whatever that fair market value is, or do you want to wait and pay the ordinary income taxes when that stock is fully vests, when you earn it, when it's yours now, at the fair market value at that date and time?
So let's say I get the $1,000 and I file the 83B election, and I pay ordinary income tax rates on that $1,000, and then 5 years down the road, when it fully vests, $500,000, I go to sell it. What's my tax look like at that point?
Yeah, so after 5 years, it's your stock now. It's vested. You've earned it. You now can sell it to someone else if you want to. So you sell it for $500,000. Now, at that point, you've converted that what could be an ordinary gain into a capital gain now. Because if you sell it then, it's a long-term capital gain for $499,000 rather than an ordinary income gain.
So the big play here is the difference between ordinary income tax rates and long-term capital gain rates, which you want long-term capital gain rates almost all the time.
Almost all the time, just because they're taxed at a lower rate right now. So it's really a timing of when do you want to pay the ordinary income tax, and just be aware that if you're receiving stock that's subject to a vesting schedule, then you need to understand how an 83B election could apply to you and if it's a good idea or not for you. So,
and most companies that have these programs, hopefully they're going to advise you to do the 83B election as well. But just in case they don't, make sure you're aware of it. So that way you can ask the question, see if that's something that needs to be done.
Yeah, and they're real easy to file those elections. It's a one-page form. You just got to make sure you do it within 30 days of being granted that stock.
Right, and make sure you keep your green card that says you sent it to the IRS.
Yeah, mail it certified. Mail it certified. 30 years from now, you don't want to depend on the IRS to
man. Right.
So anyway.
Awesome. Well, that's really good information.